If you're looking for expert insights, powerful strategies, and actionable advice, you're in the right place. Our goal is to help you level up, break through limits, and achieve success in every area of life. Each video is packed with valuable content, real-world examples, and practical tips that you can start using today. So, if you're ready to grow, learn, and take control of your future, hit that subscribe button and turn on notifications because you don't want to miss what's coming next. Welcome to the journey. Let's get started. 1. Understanding your financial situation. Before jumping into real estate, analyze your financial health. This means checking your credit score, existing debts, and available savings to determine your purchasing power. Lenders assess your debt-to-income ratio to approve financing, so ensuring you have stable income and manageable debts is essential. Have a realistic budget and consider the down payment, closing costs, and potential renovations. It's also wise to have an emergency fund for unexpected expenses. Understanding your financial position prepares you for responsible investing and ensures you don't overextend yourself financially. Additionally, consider your long-term financial goals and how real estate fits into your overall wealth-building strategy. Explore different mortgage options and interest rates to find the best deal. Speak with a financial advisor to get professional guidance on structuring your investment wisely. Finally, plan for property taxes, insurance costs, and potential vacancies to ensure your investment remains profitable. 2. Researching the market. A successful rental property investment starts with thorough market research. Study the local real estate trends, rental demand, and property values in different areas. Look for neighborhoods with strong job growth, good schools, and low crime rates, as these factors influence tenant demand. Analyze past sales data, rental prices, and occupancy rates to determine whether the area is profitable. Speak with real estate agents, investors, and property managers to gain insider knowledge. The more you research, the more confident you'll be in making a smart investment decision. Consider factors like future infrastructure developments and economic growth, as these can impact property appreciation. Visit potential investment areas at different times of the day to assess traffic, noise levels, and neighborhood conditions. Research local landlord-tenant laws to understand your rights and responsibilities as a property owner. Finally, evaluate the long-term potential of the market to ensure your investment remains profitable over time. 3. Choosing the right property type. When buying your first rental property, consider the different property types available: single-family homes, multifamily units, condos, or townhouses. Single-family homes often attract long-term tenants and require less maintenance, while multifamily properties generate higher cash flow but involve more management responsibilities. Condos may have HOA fees, which can impact your profits. Evaluate your budget, investment goals, and management capacity to decide which property type is best suited for your needs. Selecting the right property sets the foundation for a profitable rental business. Additionally, consider the location and neighborhood trends, as some property types perform better in certain areas than others. Research vacancy rates for each property type to determine which option offers the most stability. Factor in future appreciation potential, as some properties may gain value faster than others. Lastly, think about your long-term strategy, whether you plan to hold, sell, or expand your portfolio, and choose a property type that aligns with your vision. 4. Securing financing options. Understanding your financing options is crucial to acquiring your first rental property. Traditional mortgages require a 20 to 25% down payment for investment properties, while FHA loans allow lower down payments for owner-occupied rentals. Other options include hard money loans, private lenders, or real estate partnerships. Consider the interest rates, loan terms, and repayment schedules before committing. Getting pre-approved for a loan streamlines the purchasing process and gives you a competitive edge when making offers. Choose financing that aligns with your investment strategy and risk tolerance. Additionally, explore creative financing options like seller financing, lease options, or home equity loans to reduce upfront costs. Compare fixed rate versus adjustable rate mortgages to determine which suits your long-term goals. Assess your ability to cover mortgage payments during vacancies or unexpected expenses. Finally, consult with mortgage brokers or financial advisors to ensure you select the best loan structure for your investment success. 5. Calculating cash flow and ROI. A profitable rental property should generate positive cash flow and a strong return on investment (ROI). Calculate cash flow by subtracting all expenses from rental income. A good ROI typically falls between 8 to 12% annually. Use the 1% rule. If the monthly rent is at least 1% of the property price, it may be a solid investment. Factor in unexpected costs and conservative rental estimates to ensure you remain profitable. Strong cash flow and ROI are key indicators of a successful rental property. Additionally, consider the cap rate, which divides the net operating income by the property price, to compare profitability across different investments. Track market appreciation, as property value growth can enhance long-term returns. Monitor operating expenses carefully to avoid cost overruns that could erode your profits. Finally, diversify your rental portfolio over time to balance risks and optimize income streams. 6. Conducting a property inspection. Never buy a rental property without a professional inspection. A detailed inspection reveals hidden issues like plumbing leaks, electrical problems, foundation cracks, and roof damage. These repairs can be expensive and significantly impact your profitability. Request a thorough report and negotiate with the seller for necessary fixes or price reductions. Understanding the property's condition helps you avoid costly surprises and ensures a safe and comfortable living space for tenants. Inspections are an essential step in making an informed investment decision. Additionally, consider specialized inspections for pest infestations, mold, and structural integrity to uncover less obvious problems. Factor in potential long-term maintenance costs that may arise from aging systems like HVAC or plumbing. Ensure the inspector is licensed and experienced with rental properties to get the most accurate assessment. Taking these precautions can save you thousands of dollars and protect your investment from unforeseen complications. 7. Understanding landlord responsibilities. Owning a rental property means taking on the role of a landlord. This involves managing tenants, handling maintenance requests, and ensuring legal compliance with local rental laws. You can self-manage the property or hire a property management company to handle day-to-day operations. Knowing your responsibilities, such as tenant screening, lease agreements, fair housing laws, and eviction procedures, helps you avoid legal issues. A well-managed property attracts responsible tenants and maintains long-term profitability. Additionally, setting clear policies on rent collection, late fees, and property inspections ensures smooth operations. Building strong relationships with tenants through clear communication and timely maintenance requests can increase tenant retention. Stay updated on changing landlord-tenant laws to avoid fines and legal disputes. If self-managing, use property management software to streamline tasks like rent collection and maintenance tracking. Properly managing your rental property maximizes profitability and creates a positive rental experience for both you and your tenants. 8. Screening and selecting tenants. Good tenants make rental property ownership much easier and more profitable. Conduct thorough tenant screening by checking credit history, rental background, employment status, and references. A strong lease agreement should outline rental terms, security deposits, maintenance responsibilities, and policies. 9. Managing property maintenance and repairs. Regular maintenance keeps your rental property in good condition and retains its value. Budget for repairs, landscaping, and routine upkeep to avoid bigger, costlier problems. Have a reliable network of contractors, plumbers, and electricians to handle repairs efficiently. 10. Scaling and expanding your portfolio. Once you successfully manage your first rental property, consider expanding your portfolio. Reinvest profits into additional properties to create multiple streams of rental income. Diversify by investing in different locations and property types to minimize risk. As your experience grows, explore strategies like house hacking, BRRR, buy, rehab, rent, refinance, repeat, or real estate syndications. That's it for today's video. I hope you found this insightful and helpful as you take the next step toward your goals. Remember, success is all about taking action, learning, and staying consistent. If you enjoyed this content and want more videos, make sure to hit that like button, subscribe to the channel, and turn on notifications so you never miss an update. Also, drop a comment below. I'd love to hear your thoughts, questions, or future video requests. Thanks for watching, and I'll see you in the next video. Keep striving, keep learning, and stay inspired.